Another type of financial intermediaries is mutual funds. These are also called investment companies. So here we definitely take a further step away from banks, but mutual funds and investment companies actually operate in a serve the same similar purpose in a financial intermediary standpoint. They bring different parties that have different financial needs together, and they act as the intermediary. So once something very interesting about mutual fund operation, each mutual fund is a separate legal entity. And then the management company or the holding company, this is called the investment company. And these companies manage many mutual funds. So if you buy one mutual fund, for example, if you buy the Vanguard Market Index Fund, you are actually a shareholder of that mutual fund alone. The reason why it's set up that way is so that the ups and downs of any one mutual fund does not affect the results on another mutual fund. So the investment company is the holding company. The mutual fund itself is a separate legal entity. And it also has an important characteristic because mutual funds is recognized by the IRS as a pass-through type operation. The income on a mutual fund is not taxed. So when you buy shares in a mutual fund, only your income through the fund is taxed. The mutual fund itself doesn't have to pay tax. Now, the investment company, on the other hand, Vanguard, for example, by itself, is a company, and that company has to pay federal income tax if it makes income, but not the return on the stocks that the individual mutual fund earns. So this is an important distinction. So the sources of funds for mutual funds these are actually considered equity. So when you buy a share of a mutual fund, you become a shareholder, an investor, and you own equity of that mutual fund. So it's bringing investors together, and the purpose of the fund is to purchase stocks or bonds. So the primary source of fund is from individual investors contributing, and the use of fund is primarily to purchase financial securities. There are different types of mutual funds, and they can purchase things in addition to traditional financial securities such as stocks and bonds. We'll talk about those in a little bit. An investor purchasing in a mutual fund generate return in three forms. One is your traditional interest or dividend from the bonds and stocks that they invested. And also, if the fund manager decided to sell a stock or bond, they will then realize capital gain or capital loss. Lastly, if an investor decides to sell the mutual fund, then the fund's value, they are called net asset value. The value of the fund could have gone up or down from the day they purchased. So as an investor, while you're holding the fund, you earn interest income and capital gain due to trading by the mutual fund manager. As an investor, when you decide to sell the mutual fund, the change in net asset value of the mutual fund is also part of your return. So, compared to buying a stock directly, where you have dividends and capital gain, when you buy a mutual fund, you have dividend and capital gain due to portfolio turnover by the fund manager. You also have a second capital gain, which is the change in the net asset value of the fund that you purchase. Something very important when choosing mutual fund is looking at the expenses. Studies after studies have shown that the expense makes a bigger impact on the overall return than the management skill of the individual investment manager. The low fees, low fee is a form of commission. This is a percentage. It can range anywhere from 1 to 5% of your investment. So you pay this on the day you purchase the fund. Those are called front-end loaded. There are also back load fee. Those are percentage that you pay if you sell the fund. Some funds has a graduated back-end load that they are higher in the first few years, and then eventually goes away as your length of ownership increases. And the back-end loads oftentimes are there to discourage investors from turning over the portfolio too often. There are a lot of funds that are no-low. For example, Vanguard is very famous for its no-low fund, so it does not pay commission for the stockbroker to sell you the fund. And then another one is called 12B1 fee. This is particularly important because 12B1 fee is not a one-time fee. It's a recurring fee every single year, and it's specifically targeted for marketing and sales. So 12B1 fee doesn't really affect the performance of your fund. It is imposed in there by the fund company to help them sell the funds to other investors. And then the more typical are the advisor fees and management fees. You can expect index funds to have a much lower advisor fee and management fee fees compared to actively managed funds. One area where mutual fund competes with other financial institutions is money market funds. Money market funds typically invest in very, very low risk, and they offer a very attractive return compared to savings accounts in banks. So in fact, you see many banks also sell money market funds as an alternative to investors. So when we compare the functions of mutual funds, money market funds is really the only area where the mutual fund company interacts and competes with other financial institutions. So now let's take a look at all different types of financial intermediation that facilitate investment in equity. So banks typically don't invest in equity. Banks typically take deposits from some investors, and then they give loans out to investors. The following financial institutions take contributions from individual investors, and then they use the contribution to invest in equity. The first and most common type is open-ended mutual funds. This is what people typically think of when we think of mutual funds. For open-ended mutual funds, investors can buy shares directly from the investment companies, and the price is called the net asset value. The net asset value for open-ended mutual funds are computed once a day at the end of the day. So if you place an order, for example, to buy a fund at 10 o'clock in the morning, that transaction will get processed at the end of the day. Will get processed at the most recent trading day's price. Closed-end mutual funds, in this case, the shares can be purchased from the investment company when those funds are newly formed. Once the funds are formed, they closed. So closed-ended here means that no new investment can go directly into the investment companies. So when the fund was first created, investors can buy shares directly from the company. But once that is closed, once the fund closes, then they can only buy shares through a broker. In fact, they can only buy shares from other investors. So if you buy a closed-end mutual fund and you need your money back, you do not go get your money back from the investment company, but instead you have to sell your shares to another investor like a stock through a broker. So closed-end mutual fund, it operates a little bit more like a stock. In the initial offering process, the money goes directly from the investors to the fund company. But once the offering is done, then transactions occur between investors through brokers. Exchange traded funds is much more similar to closed-ended fund, except that the shares are traded on stock exchanges, and the price for the shares changes continuously throughout the day. So in terms of pricing, you can get a more recent pricing for exchange traded funds. This is a lot more like a stock. Hedge funds are subject to very different regulations than open-ended mutual funds. The reason for that is because the investment in hedge funds are restricted to accredited investors, and the SEC defines what an accredited investor is. It's typically based on net their net worth, meaning how wealthy they are, what's their total asset, and also their income. The idea is that only accredited investors that can afford to tolerate the risk is allowed to invest in hedge funds. And because of that, hedge funds has much lower reporting requirement, and they are subject to much fewer regulations, and they are able to invest in much higher risk investments. And typically, a hedge fund has a very high initial investment and withdrawal and restriction on withdrawal from the investments. So because hedge funds are highly individualized and not regulated, you really need to read the perspective carefully if you want to buy a hedge fund to know what that fund specializes in. Each hedge fund is different, each hedge fund is unique. Unlike open-ended mutual funds, these are highly regulated funds. They have to follow the SEC rules on investment companies. In return, they gain a special tax treatment, and also they are allowed to sell stocks or shares of the mutual funds directly to individual investors. So you can open a mutual fund account for as little as $100, $500. So from open-ended mutual funds, if you want your money back, it's very liquid. You can redeem it by the next trading day. For hedge funds, they oftentimes have restrictions on redemption. So once you invested in the hedge funds, if you need your money back, you may not be able to. Something that's very closely related to a hedge fund is venture capital fund or private equity fund. So again, these are typically restricted to accredited investors, and they invest primarily in private companies. So a hedge fund can invest in a public company, but they can pursue very specialized trading strategies, especially computerized trading algorithms. Venture capital fund and private equity funds specialize in private companies that has not gone public. Venture capital funds typically specialize in new startup companies, and private equity funds tend to specialize in turnaround. These are companies that are in distress, and the private equity fund will either buy them, turn them around, or typically involve cost cutting and layoff or mergers. The last type of financial institutions that we'll look at are securities firms or brokerage firms. These are investment banking companies. They provide a variety of services. So we'll focus on the service side. So they are a form of financial intermediary because they help businesses that need money raise funds. And this is a large part of their business. So those are called investment banking. Investment banking is to help businesses raise money that they need. Underwriting is the primary business function of securities firms, or where they generate most of their revenue. So underwriting typically focus on either stocks or bonds. Stock offering, the most difficult one is IPO, initial public offering. This is when a company sells stocks to the general public for the first time. Is very expensive and time-consuming, but translation for a securities firm is time-consuming and expensive for the company, which also means provides a lot of revenue for the securities firm. In addition to taking company public for the first time, they also continue to offer equity whenever a company needs funds. So this will be the seasoned public offering, or anytime a company needs to raise money. In addition to selling equity to the general public, securities firms also help with private equity placement. So as venture capital and as private equity becomes more and more important, securities firms often does the bookkeeping and the back office work for venture capital firms. So if a business is looking for a venture capital firm, sometimes they'll actually go through an investment banking firm to find a venture capital investment. as far as the public offering, whether it's initial public offering or seasoned equity offering, the primary role of the securities firm is to set the offer price, and they will form a syndicate. A syndicate is a group of investment banks to help distribute the shares, because they need to find enough investors to buy the shares that the company is selling. So in addition to stocks, security firms also sell bonds to the general public. And these bonds can come from private companies or municipalities. So even universities and states, when they issue bonds, they will also go through an investment banking firm. The only government organization that does not is the federal government. So if you're buying treasury bonds, you buy it directly from the treasurer, the Treasury Department. Other than the Treasury Department, most of the other agencies, they will issue their bonds, they will still use an investment bank. So their primary role is in setting the terms. That includes the coupon rate on the bond, the maturity, the call provision, and any other provisions. So sinking fund provisions, collaterals, if it is a floating rate, the floating rate provisions, and any covenants that either restricts or limit the company's what the company can and cannot do. All those terms has to be included in the bond offering. Just like stock offering, it's important for them to form a syndicate to help them distribute the bonds. Bonds can, again, be a public offering, like stocks, or it can be a private placement. Private placements are much more common with bonds. These investment bankers will set the terms, and they'll form a syndicate, and the syndicate could then go into private placement and distribute the bonds to the primary clients, which includes mutual pension plans and also insurance companies. More recently, a larger and larger portion of the revenue for securities firms come from securitization. Securitization is creating derivative securities that are based on other financial securities. A famous one is mortgage-backed securities, where bonds are created based on mortgages, which are loans that banks have, mortgage loans. So there are also other types of securitization, and these are based on other types of asset. And this can be any other loans. This can be auto loans. This can be credit loans, credit card loans, meaning they can also be student loans. Another function that the securities firm perform is in mergers and acquisitions. They can be on either side of the transaction. They can be the company who is looking to acquire someone else, and they can also be at the side helping the company who is the target of an acquisition negotiate terms or try to defend themselves from being acquired. So in this type of transactions, they get advising fees and along with legal and transaction fees. In addition to helping the companies that are successful, they also help companies who may need, who are not doing well and need restructuring. And restructuring oftentimes means issuing equity to replace debt, because most of the time when companies are in financial distress, they can't afford to pay off their loan. So in restructuring, they also will help negotiate terms with the current creditors and thereby be able to help the company avoid bankruptcy. So this is the side of the investment banking firm that work with businesses and organizations. The other side of the investment banking firm is to work with individual investors. This is the brokerage service. And the most important part, from the perspective of the brokerage firm, the highest revenue generating service is money management. In money management, the broker actively manage the investments for the client. So they decide what stocks to buy, what bonds to buy. They will have to get authorization from the client, but they will make the recommendation and perform the trade on behalf of the client. Sometimes the client will actually give authorization and allow the broker to do those transactions on their behalf without their active involvement. Management fees for those services are typically much higher than other types of investment brokerage services. Trading is another major service that investment banking firms provide. From trading, the fees they earn are through trading commission. Some brokerage firms are considered full-service broker, and others are considered discount brokers. Full-service broker provide advice. They're not fee-based advice, but rather they are free advice, quote, free advice, but they charge a higher commission. A discount broker only execute trades and doesn't provide advice, and they typically charge a lower commission. In addition to charging commissions, if an investor trade on margin or short sales, then the broker also earn interest on the margin accounts. So those are the two main services, underwriting and brokerage service. In addition to that, some securities firms also conduct proprietary trading. Proprietary trading is when a brokerage firm, an investment banking firm, buys and sells stocks on behalf of the firm itself. And oftentimes that take on risk. Because they have access to a lot of capital through the investment banking and brokerage service, they oftentimes can take on a lot of leverage in the proprietary trading. And that has led to this is somewhat controversial. Some securities firms do not participate in proprietary trading. Some of them participate limited amount of proprietary trading, primarily to facilitate a transaction. So, for example, if a brokerage firm, an investment banking firm is trying to issue stock for, say, an IPO for a new company, and they could not find enough investors to buy the shares, the investment banking firm may buy those shares themselves. When they do that, they're engaging in proprietary trading. So that's one way. And then there are firms who actively participate in proprietary trading independent of the investment banking services and the brokerage services. So all these firms are subject to different types of regulations. The SEC, the Securities Exchange Commission, is the primary regulatory agency on underwriting. They put most of this has to do with most of these regulations relates to the company who are selling the stock rather than the brokerage firm. So the company has to register with the SEC. They have to once you become a public company, you have to follow this disclosure requirement, meaning that when you disclose information to the public, you have to disseminate that information equally and or simultaneously to all investors. They have filing requirements with these are the 10Ks and 10Qs. These are the financial statement filing requirement and any major material informations. Regulation FD. FD stands for Fair Disclosure. That has to do with when the disclosure requirement is an earlier regulation, it regulates what information needs to be disclosed. Regulation FD says that those information must be disclosed in a timely manner simultaneously to all participants. What analysts can say and who gets information first is regulated by the analyst rating. So all those are regulated by the SEC. In addition to SEC rules, each individual stock exchange, if these are private companies, they have their own rules as well, and they differ from exchanges to exchanges. So I encourage you to go to New York Stock Exchange, NYSE, and look at their regulation versus NASDAQ. Lastly, there is an agent. There's a private. Again, this is a private corporation called SIPC. SIPC offers insurance on the cash and securities that are deposited at brokerage firms. So, for example, if I have a brokerage account with Vanguard, or I have a brokerage account with Goldman Sachs, the stocks I own actually resides with Goldman Sachs. Today, these are all computer records. If Goldman Sachs goes bankrupt and they have been using my stock, I am protected up to $500,000 of all my investment that are with Goldman Sachs. So this is similar in spirit to the FDIC insurance for banks, but SIPC applies to brokerage firms. The 2008 financial crisis has tremendous impact on securities firms. The reason was that they were very, very much involved in the securitization process, and they also engaged in a lot of proprietary trading. And during this financial crisis, they faced severe liquidity problem. And in order to solve their liquidity problem, they need to borrow money from the Federal Reserve. Now, however, the Federal Reserve is only available to banks, not to securities firms. That was the rule that was set down way back in the 1930s to avoid investment banking firms, failure of investment banking firms, bringing down the entire economy. As you can see, we are back to square one in 2008. So the government basically decided that the security firms are too big to fail, and they allowed them to become bank holding companies overnight. And once they are bank holding companies, then they can borrow funds from the Federal Reserve. But by becoming bank holding companies, they are also then now subject to banking regulations, not just SEC regulations. So that is the immediate impact of the financial crisis. This has become household names, the major failures in 2008. Lehman Brothers was the first one. They actually went bankrupt. And then Merrill Lynch was bought out by Bank of America. So Merrill Lynch also no longer exists. Bear Stearns was also close to failure, but they were bailed out by the U.S. government. They were bailed by the U.S. government indirectly through a loan.